on to the Smart Property Investment Show with your host, Phil Tarrant.
G'day. Thanks for joining us on the Smart Property Investment Show. Great to have you on board. Love talking about property. It's what really excites me, wakes me up in the morning. I do apologise in advance. However, just got off a plane from London this morning, so sort of towards the back end of the day. So I've had a couple of coffees, but hopefully it keeps me going. But that shouldn't stop another stellar podcast. I hope you enjoyed. I was going to start this by chatting off air with our podcast guest this time around, Jonathan Preston. I was going to ask him what's been happening last week because I haven't been in town in property, but I'm going to ask him about what's been going on. What's been in the news the last week or so? I've been off the grid for a while in properties. Usual stuff.
It's all Royal Commission at the moment, and actually I saw an email come out yesterday. I don't know if it was broker intended, but I'm sure by this point it's made it to the whole market. That CBA is following. I think it was NAB who was first to do it. The income to loan ratio capping at 7%.
Okay.
So that's kind of a big thing because a lot of property investors are set up so that their cost of living is not so high. Then they're heavily negatively geared to increase borrowing capacity. And with CBA making this move, I think that is going to get followed by a few more lenders. So that's, I think, a big move in the financing space that's going to affect a lot of investors going forward.
So you're a mortgage broker. You sounded like a mortgage broker then. So let's talk about that. So you're a mortgage broker. You've been doing that for okay, cool. So a 7% ratio. So
seven times
ratio.
Yep. So if you're making $100,000 a year,
you can
total
borrow
debts,
$700,000.
700, and that's like even if you're beautifully set up, living at home, rent free. They got the notional rent in there of I think $150 a week, which is about $650 a month. But let's say you're living at home, rent free, and you got 5 or 6 properties. They're renting well, but they will only say, okay, once you've hit that 7 times cap, we don't want to deal with you anymore business than that. And that includes credit card limits and car loans and stuff too.
Okay, so if you've got a $20,000 credit card but with a zero balance, they're going to still count $20,000.
Correct.
Okay.
Yep. So it really hits the people who have multiple properties.
Yeah.
And even if they're quite well set up in terms of, yield and everything like that, eventually, your base becomes less relevant, and the reliance on the interest deductibility of the debt plus the rent, is what brings up your servicing. And before, I'm pretty sure it was only NAB and not many, if any, other lenders really had like a specific number there. As long as you passed the calculator, you were good to go. Obviously, some lenders got out of negative gearing and have had more difficult calculators. But with CBA doing it, they've often been a big player in the investment space. I think that's a really big piece of news over the last week.
Okay, that's cool. We'll move upwards. But so what we're talking about there is really increasing, and you speak to investors and everyone's saying, it's hard to get finance now and not as easy as what it used to and this sort of stuff. And this is just another mechanism which is going to, number one, potentially limit investors the speed at which they can invest or the size of the portfolio they may be able to create. But number two, a lot of this is going to be impacting on cash flow as well. So investors need to be really thinking about, number one, can they afford to invest at the moment? And then number two, how they're going to go about doing it. So what you have in this market right now is all these mechanisms that have been placed on lenders. Some of them have been self-imposed. Some of them have been done so on behalf of the regulatory bodies to try and slow down investment lending. And this has been going on for a little while, Jonathan, hasn't it?
Exactly.
You as a mortgage broker, you've been seeing this. This capping growth of interest-only loans is, a lot of lenders have been sort of redlining that and being pretty close to it. But, from what I understand now is that, it's the heat's not as much there on behalf of APRA on that sort of number. So you're getting some lenders who are willing to invest more, are willing to lend more to investors, but they're putting these new roadblocks in place. It makes it harder. So, I guess I've got you onto the show today to talk about your portfolio, but just with your mortgage broker hat on, are you seeing this impact? Are you seeing a lot of investors getting knocked around and unable to borrow, or they just have to be smarter with how they do it?
Definitely. And the bigger the investor you are, the more the challenges really remain, because we've got that APRA imposed assessment rate across the APRA regulated lenders, typically 7.25 minimum. Even if you've got a beautiful portfolio, millions in equity, people have just hit a brick wall. And so we've seen a lot more people having to be open-minded about going to to the non-conforming lenders and paying that slight premium on interest rates just so they can keep building out the portfolio. And my experience there has been that the savvier the investor, the more open-minded they are to that strategy versus someone who's a newer sort of investor that may be quite kind of scared of that. But you've got to do your own cash flow modeling and make sure that you are able to afford the repayments, because you don't want to take on debt you can't afford. But certainly we come across people day in, day out that have got 5, 10, 15 properties, multi-millionaires, and then when you plug it in, maybe they make 150 grand a year in their job, but when you plug in 5 million of investment debt, then pretty much calculator almost always says no. And if we go back a couple of years, we were able to sort of multi-layer lenders and get them to assess each other's debts in different ways and be a little bit more creative in that regard. But right now you're pretty much either having to go non-bank specialists to get away from APRA, or you have to go all the way up to sort of almost at a private level, like high net worth banks, where if you say you're a 5 million plus loan investor, they may be able to be a bit more creative, structure the loan through non-NCCP entities, so company or trust, perhaps on a shorter term, and then we may be able to do some more in terms of servicing. But those are the two main pathways we're seeing for a lot of investors who are getting stuck right now.
Okay. So, and do you think this is just the way it is right now? It'll change in the future, or you reckon this is going to be the status quo?
I'm hopeful that it's going to deregulate in a few years, but I think with the Royal Commission in place, we're certainly not going to see things open up hugely in the near term. We have seen IO rates, come down a bit from the big banks for like 2 and 3 year fixed in recent times, which is a big change from, if we go back, about a year, we saw IO rates go through the roof. But I think the banks have looked at their books and seen that they're way under the cap, and now they can take on some more IO loans. So interesting that IO rates have actually come down recently, I think, because the banks haven't seen a lot of those loans. And we've got to remember that IO loans are much more profitable for the banks because they don't amortize. So they prefer IO. It's just the regulatory environment doesn't allow them to do it. So near term, I'm not expecting things to open up, but we have seen, if we look at some other markets, if we look at, Trump coming in the US, we saw, a bit of a deregulation stage in terms of the banking system over there. So we went through that regulation stage in GFC, post GFC, and then deregulation is starting to come into place now. And if you go and look at, say, Singapore, they had a really hot property market. Lots of regulatory reform came in. And then after, I think it was about 3 years of the market slowly going down, the regulators turned around and said, okay, we're happy to ease some of the regulations now. So with the market eventually hopefully turning, with the Royal Commission hopefully behind us in time, I'm hopeful we'll see things open up again, but it may not be too near. It might be a little while away, I think.
Okay. I appreciate the insights, Jonathan. Thanks for that. And if you're tuning in and you're worrying, go speak to your mortgage broker is the thing to do. I'm obviously chatting with mine. Serviceability is always a bit of a challenge for all investors. Even if you've got a large portfolio, just gets a lot more complicated. But anyway, let's chat about you as a property investor, Jonathan. Why do you invest in property?
I think a lot of it comes back to the amount of leverage you can actually employ, and also sort of my upbringing. So my parents kind of instilled in me, from growing up, property. I grew up actually in New Zealand, came here when I was 13. In New Zealand, my parents had quite a good house from when my dad had a business from when he was younger. So they were able to hold on to it after the 87 crash, and the 87 crash affected New Zealand, I believe, worse than any other country in the world. America bounced back straight away, New Zealand not so much. So they subdivided the place we lived in a very good area there, and we moved into the back property. Okay. And then in the remaining years, my parents went on to acquire a number of investment properties. So they made good money in property, and they did well, career-wise and everything, but it wasn't multi-millions or anything like this. It was property that made their wealth, and so they kind of instilled that in me the whole way along. And it took, I guess, some time to get into that. When I got out of school, I went initially into more the finance and sort of stockbrokering-ish side of things, but I realized that it's kind of sustainable leverage that you can hold for the long term through a couple of growth cycles that is what really makes you wealthy, as opposed to short-term speculative activity activity. And property, being at 80, 90 LVR, you're at a pretty good leverage ratio. And so you only need property to move, a little bit in your favor. And if you can hold it for 5-10 years, that's where the wealth's going to be. So when that kind of clicked in my head, that's when I realized I needed to sort of be in the game and got a bit more serious about it.
So you're making some money? You getting there?
Done all right. So started late 2012.
So how old are you now?
31.
Okay.
So started late 2012. So I wasn't super young, but I'd been saving a bit of money.
Most people say it's pretty young to start investing at 25 or whatever it was, right?
Yeah, I mean, I started saving money. So I did the stupid thing when I was like 18, spent a bit much, got some credit cards, bought like a laptop on credit, all this. Then I think I read Rich Dad, Poor Dad, and I read the Steve McKnight books. And then I was like, okay, I'm doing this all wrong. So then I brought my living expense down, saved some money, bought some shares, invested in that for a while, made some money in some stocks. And then that's when I turned around and used that as a deposit. So it is all self-made money. First place I bought was late 2012, 2-bedroom, old style walk up, 2-bedroom in Liverpool, just near the station there. It was, I think rent appraisal was about 300-ish a week, and I paid $217 for it, and it had been relatively recently renovated, and I figured, on that rental yield, I think I put down about 15% deposit. It was strongly positively geared. I thought the location was good. It was commutable to Sydney, and I guess as soon as I owned it, I was like, wow, what have I been scared of all this time? And I was like, off we go, let's do this.
I'm sure you've done pretty well. And we'll get back to it. But so you're doing this for wealth creation, right? Nice retirement, I guess, right? That's why everyone else is doing this. You're still relatively young. Do you know how much money you want to retire on when you choose to retire? Have you got that number sorted out?
So the idea was that I'd retire by 30 with $1 million equity, and then I would switch to more of a yield strategy, and then I would, travel the cheaper parts of the world, say South America, Southeast Asia, and just live on 50 to 70K a year, maybe do a bit of online work to supplement that. That was the first goal. And then as I've sort of progressed in the career and I've sort of found my way to broking, I've realized that actually I really like my work. I like what I do, and I'm not sure what I would do with myself if I literally had that much free time. So kind of the goals have changed. Now it is more a long-term wealth creation strategy. Don't ever intend to retire. And I'm fortunate enough that, I'm lucky that, working with the clients I work with, which a lot now are self-generated. So either referrals or people I know or people who have come through other means of advertising or relating to my name. I find that very enjoyable to work with. So kind of the dream has changed a bit. I do intend to build up the portfolio more, but now it's just, I guess, about getting very wealthy, building up my business as a broker and kind of, I guess, enjoying life as we go. Yeah.
So I imagine if I speak to you in 20 years' time, you'll give me a different answer to this, and you never know what happens. But what does wealthy mean to you?
I got a few goals.
Yeah.
I got big goals.
All right, tell us about it.
So I want to make $100,000 a month as income.
Okay.
I want to own like 100 plus properties.
Yep.
And I want to do big things in terms of like changing the world, like sort of save 1 million lives, all this kind of thing. So these are long-term goals and certainly not stuff you can pull off overnight. But, you got to have dreams, right? So that's the long-term goal. And, I've made minor steps toward that. But certainly there's, not many people get to, I guess, those numbers. But, I guess I've got another 50 years to go and compounding's on my side. And if I work hard, maybe I'll get somewhere in the region of those. And
So tell me about those goals. Like why? Well, like that, why do you need that much money? So you can save 1 million lives, but why do you need that much money? Just because you can do it? So it's just a challenge? Or
I think so. I think it's more of a seeing where your potential currently is and seeing how far you are from your potential. So I follow, some of the big sort of American guys, and Grant Cardone's a big influence of mine. And I guess the thing is, it's kind of, I guess I've realized that I'm very competitive as a person. So the place I work, like I have to be top of the results all the time. I want to try and get in the top 100 for brokers next year, and I'm not far off hitting it actually this year, but I'm probably going to be, a little bit short of the numbers required. But now it's become more about competing than money. But, if I can get anywhere near these goals, having that security of cash behind you means that I'll always be in a strong position to control my own life. And if there's ever anyone in need in my family or, anything like that, then, they can hopefully rely on me to make sure everything's okay. So it's not so much a monetary thing. I've become less monetary. Like having showy things is not of high value to me, but being free and doing what I love, that's more important, and being competitive.
Are you a good competitor?
I think so. I'm pretty much number one on the stats year round at our place, and I pretty much don't sleep if I'm not. But
what makes you a good competitor? That's results. But what makes you a good competitor? What is it about your makeup or the way you're wired that makes you compete? Whether that's at work and being at the top of the sales board, or growing a large portfolio.
I'm not really sure. I think it's just part like hereditary maybe, or the way you're born. Even in school, I competed a lot, and I got to the top level at like the World Cyber Games in Australia for Counter-Strike, and so I've just been a competitor playing games and everything my whole life. And when I've sort of gotten into business and investing, then that same kind of mindset has stuck with me. One thing I have learned is that when it comes to employing leverage in investment, you need to be mindful and careful with your competitiveness, because if you over leverage just to be the biggest and the best, the market can very much turn around on you, and you can lose a lot in one go. And so certainly my initial endeavors, I was taking more risk in terms of what I was investing in the leverage undertaken, and that's where I found kind of a sweet spot with property, where if you're at an 80, 90 LVR, you're still quite heavily leveraged, but because the assets are not being valued every day and the bank doesn't repossess them if they go down 1%, then you're potentially able to hold for the long term and withstand the growth. Versus in a lot of financial assets, if you leverage up and you lose, it's game over. So that's something I've had to wrestle with.
So being a competitive person means that you like competition, and in a competition you typically have a winner. So thinking about property investment, what does it mean to you to win in property investment? And I guess a second part of that question is, how do you celebrate your wins?
So I guess it's hard to say winning, because there's so many immensely successful investors that you can come across online, and that we know of here, and I'm sure you've had a lot of them on the show here. There are people that are wildly successful compared to where I am. So I don't know if I could say that I'm winning in that regard, but certainly there are some
winning against other people.
metrics.
Is that winning yourself? What does it mean to win yourself?
I guess just to advance is something, and they have those statistics, and I don't know the exact numbers off the top of my head, but I think statistically in Australia, the amount of people with more than 5 or 6 properties is a very small fraction. And so I guess to move up that ladder, and I guess to be of higher net worth as compared with the Australian average and the global average, I guess that becomes a bit of a competitive scale. Obviously, we're born in a very wealthy part of the world, and we're given a lot of opportunities that a lot of other people aren't. So we've got to factor this in. But still, there are some metrics that you can compare, I guess, yourself against others, and definitely there's always going to be more successful people, but I guess moving forward, and for me, I don't know, I get like this amazing feeling when I buy a property, actually, like when so it's like endorphins sort of run through your body when you've actually made the purchase. Exactly, like when the contract is exchanged, if I feel like I've gotten a good deal. I remember the second to the last one I think I bought, I literally danced around my apartment. I was so excited, so do your friends, colleagues, mates know what you're doing in terms of your property investing, or do you just do you share? Yeah, I'm pretty open, to be honest. And I mean, I share what I do online as well. And I guess, people like, and some people don't like that, but I'm pretty open as a person, and if people want to know, then that's fine, but I don't try and like stick it in their face if they're not doing well. These days, I think that people tend to end up sort of hanging out with like for like people, so I find most of my circles now are quite successful investors and people who are doing really well in their careers. So most of those people are sort of happy talking about their investments and what they're doing and how their career's going. And we don't always get into like exact numbers, but certainly my main circle of people that I hang out with now are generally millionaires or very, very wealthy self-made people. So but yeah, I do share everything pretty much online, so I'm pretty open as a person.
So you say you hang around other people who invest in property and going down this path. What's the common thread that binds all of them together that makes them hungry for property and property investment?
It's a hard thing to know, but I guess everyone, some people are just wired in terms of that their mentality is that they want to become wealthy for whatever reason, and their interests become in investing and following the market and following property. And I guess, some people, they're just not interested in that, and that's fine. They obviously have things in their life that interest them more. Perhaps wealth creation doesn't sit at the top of their list of priorities, but you just find a lot of those people, often they're that type A sort of competitive personality, those kind of people, and they'll generally excel in their work, and then they'll be looking for like-minded people to talk to on the weekend about where they're investing, where they see the opportunities, and then I guess over time you end up sort of forging stronger friendships because you have those things in common, I guess. Yeah.
Well, obviously it sort of drills you a bit on this mindset part, and speaking to a lot of investors, and I speak to a lot of investors, and they might only be thinking about investing in property through to people with very, very large portfolios. Everyone's got a particular sense of hunger and enjoyment of investing in property, with the idea that a lot of them love the process and really get involved in the process, whereas other people don't really care about the process, they care about the end result. But by and large, everyone is focused on how they can improve their lives through investing in property. And for some people it's about living a great retirement, for some people it's about building generational wealth, for other people it's about liquidating and give it all to charity, so everyone's wired a bit different. But I just wanted to drill down a little bit on your mindset. However, on the Smart Property Investment Show, a lot of feedback we get, people like to drill down into people's portfolio. I think it's quite voyeuristic for most investors to know what other people are doing, and they either look to emulate that or use it as a benchmark, or even if it's just a bit of jealousy, people like to know. So let's break down your portfolio really quickly, Jonathan. We've got about another sort of 10 minutes. So you said you purchased your first property in, by memory, I didn't write it down, but Liverpool for about 212 grand or something or other.
Yeah.
Liverpool. So Liverpool, for our listeners who don't live in Sydney, is sort of southwest suburbs, about 35, 40 kilometres from the city. It's a big CBD, really. If you think about Sydney, you'd have Campbelltown, Liverpool, Blacktown, Hornsby. They're all sort of similar. They're similar distance out of the city. Hornsby a bit more expensive. So it's on a train line. Huge amount of growth out there. There's a lot of Liverpool, by memory. It's a whole bunch of stuff further west from that, which is a new developments, whereas Liverpool's quite established. And I think it's had some zoning changes there as well. So I bet you that property is worth a lot more than 212 grand today.
So paid 217. I reckon 400, 420 today's market. Currently renting it out for 300 a week, and I had the same tenant in there from literally like 2 weeks after I bought it until about 2 months ago. So I had someone in there for a really long time, and that was awesome.
Did you punt them or they left?
No, didn't punt them and never increased the rent on them.
There you go.
I said, like, if they keep paying and they've been so good to me, they can keep it where it is now. And I mean, look, it's not like rent, locally was doubling or anything. So I was happy to keep them. And so I think we had a good relationship. They asked me to make a few changes and put some like security like window things in and stuff like that, and so I did all that for them, and so that was good. So that was the first purchase, and that gave me a bit of equity to sort of play with. The next one was August 2013, so 8-9 months later, I bought a 4-bedroom townhouse, so it's detached and part of a block of 8. That is in the North Mount Druitt suburbs. So just north of Mount Druitt, we have sort of a grouping of suburbs there. And
which suburb was it?
so I prefer just to call it in that region there because they're all quite tightly held, that area.
All right.
But, there's...
Yeah, North Mount Druitt. So you're thinking Bidwell, Wayland,
This region.
Edmonton.
Exactly.
Yeah, okay, cool. Yep.
So 4-bedroom there. It's got a garden, quite big. I think it's like 444 square meter block or something.
Cool.
Paid $238 for that.
Yep.
And inside had been recently renovated as well, most of it anyway, except for one of the bathrooms.
Okay.
Today, that property, it's hard to value, but somewhere between near 540, I would say. Like that's been a big win. I got that way under market. It's a big property. It's 4 bedrooms, and it's got the garden and stuff. So it's and you see houses there often trading at 600, give or take. So I think that. Being the size of a lot of those houses, it's in that region.
Cool.
It only rents for $315 a week at the moment. I had it renting for $345 at one stage, but I am very picky with my tenants, and I will take way less money for a better tenant.
Yeah, I think also that sort of western suburbs of Sydney, you bought it 2013. There's a huge influx of investors out of that point of time, and there's a lot of property on the market for renters, which obviously there was a negative price pressure on rents, and I saw some of our rents go down out there just purely because there was so much choice. But okay, that's cool. All right, so what was after that place in Mount Druitt?
Yep. So then there was the next one, similar area, October 2013. So just a few months later, I bought a 2-bedroom, $208,000. Again, a townhouse. So this one's got a little garden as well. This one is disconnected as well, so it's not connected with any others. Today's value about $420 maybe.
Okay.
Because it's got a garden and whatnot, and because it's detached. And that's renting for $275, I believe, at the moment.
Okay, cool.
So that one, again, done, I think pretty well in terms of, the growth there. And then I bought another one, again, in a similar region, 3 bedrooms. Again, a townhouse. But this one, I think is sort of connected to the next place. I actually never got to view this property. I just got to the outside. The agent said, I can't take you to see it. I've got a Christmas party that day. And he said, you can go and knock on the door and the guy will let you look at it. I knocked on the door and the guy didn't let me in. And I called him and I said, I'll take it. So I paid $210 for that. Rents at the moment for $285, and because it's a 3-bedroom and it's got a garden, I'll probably estimate it to be worth about $440. So that's a little bit bigger than the 2-bedroom, but the condition's not amazing. And then the last one that I bought, so Sydney had kind of run up, quite a bit. And the years after that, I had some servicing issues. So I ended up buying a 3-bedroom standalone house in Redbank Plains.
Okay.
So just, just sort of outside of the Brisbane LGA there. It's a late 90s build, no strata because it's a freestanding house. Not a huge block, but look, it didn't need any work, not old, and I didn't have to pay strata. So those were the things. What I was looking for was a low value house, not in a flood zone, commutable to Brisbane CBD, and rent. I paid $253 for it. Rental appraisal was up to $320, although I have taken a tenant in for a bit less than that. And that one, I don't think it's gone up that much yet, maybe $270 on the upside. So that one's been my slowest growth, and perhaps I could have done better than that. But buying interstate can be hard. So
I think that's just the story of Brisbane. Depending who you speak to, they reckon a whole bunch of growth is going to come. But the thing is that you can't use your experience in the western suburbs of Sydney as a basis for how other property markets are going to perform. That sort of period from 2011 to 2015. 16 has been madness out there, western suburbs of Sydney. That's cool. So what's the total value of your portfolio, do you think, now?
Between $2,050,000 and $2.1 million, around there, probably towards 2.1.
Yeah, and how much debt are you carrying on it?
About 1.2.
1.2. Okay, so it's not really that highly leveraged now.
No,
was that sort of 50-something% LVR, right?
Pretty much, yeah. So bank values may differ slightly from these figures, but give or take, it's
even on the bank value, you might get 60% LVR. So you got plenty of equity. What are you going to do with it?
So I guess the point where I'm at the moment is building up the broking side of things, so I can service more and buy more properties. Basically, that's the main thing. So it's kind of, if I can get a win-win in terms of building a big client base, getting the right outcome for my clients, then it's going to help me with servicing, and I can buy more places as well. So I'm considering doing a bit of non-conforming to add to the portfolio, but we are near the end of the financial year, so financials are starting to build up. So I'm sort of reviewing exactly where that is at the moment. My views on the market have changed a little bit as well. Previously, I felt like outer suburbs had more of a risk premium associated and much better yields, versus I feel there's been a lot of yield compression, particularly in the Sydney region over the last couple of years. And so actually my appetite has tended more toward bluer chip areas in Sydney in recent times. So I would look to spend more on the next purchase. So that also goes against me serviceability wise. So not rushing into anything right now, but certainly the plan is to, over the coming years, as the broking side of things really builds up, which it is really building up, to expand out the portfolio, because the equity is there to use. Yeah.
Cool. Well, let us know how you get on with it all. It's a good spot to be, and obviously there's challenges with everyone with serviceability and securing finance. But as we mentioned at the start of the podcast, markets change, banks change all the time, right? They're under the heat at the moment with the Royal Commission, and and I think a lot of people think it's probably long overdue that there is an inquiry into the banking system. We're fortunate in Australia that our banks are so strong and have been over years, and it's held the nation, the economy in good stead. But a bit of review that probably had to happen. That's underway right now. Your tips, Jonathan, for anyone who is looking to be successful in property investing that hasn't started investing yet, what would you tell them?
So you do need to get a bit of money together. If you don't have money, you can, I think the first time owner's grant in Queensland's about to end, but you could potentially go look at that pathway. If you can live in Queensland for a little bit, get that 20 grand to get you going. Start as young as possible, but sort of recent views are that if you are looking for a vanilla investment to hold for 20 years, you probably want to be buying in Sydney or Melbourne, and you probably want something heavy land value. If you're willing to be more adventurous than that, then maybe you go with something you could subdivide, a mini development, or maybe you buy something that you rent out on short-term rentals or room by room, and then down the track you can expand on that. So depends how entrepreneurial you want to be in terms of your property investing, and also do you intend to make your property investing a full-time thing, or do you intend to build up a career in the background, and then that's going to help with your decision as well. So that's probably the main thoughts on the market at the moment.
Nice one. Thanks for your time, Jonathan. Appreciate it.
Appreciate you having me.
And remember to check out smartpropertyinvestment.com.au. If you're not receiving our daily morning market intelligence newsletter, first to know what's happening in property, smartpropertyinvestment.com.au/subscribe. If you'd like to get your info from social media, we're pretty active there. Just search Smart Property HQ on any of the big social channels to track us down. Remember to tell your friends as well about what we're doing on the podcast. The guys here love the reviews that we're getting, and also those ratings. So we've got plenty of them now, and please keep them coming. If you like what we're doing, we're just trying to grow this community even further. So we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.